Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Welcome back to the Deep Dive. Today we are wrestling with a concept that sounds, well, simultaneously like an impending economic crisis and maybe a bit of overblown hype. The Silver Tsunami. This phrase, it suggests a massive, imminent shift in U.S. ownership, driven by the baby boomer generation retiring en masse.
It's certainly a compelling narrative, but whether it's really a crisis or maybe more of a myth, that depends entirely on which part of the economy you're looking at.
Okay.
We actually need to split the tsunami, as you called it, into two distinct waves based on our sources. First, there's the immediate, very practical succession crisis facing small businesses, Main Street.
Right, the local shops, the services.
Exactly. And second, there's the much broader, multi-decade Great Wealth Transfer, or GWT, happening across all asset classes. Much bigger picture.
And the raw numbers we pulled from the sources are, honestly, they're staggering. They paint a picture of unparalleled economic transition.
They really are. If we look at the total intergenerational wealth transfer, sources estimate up to $124 trillion in assets are set to pass down to younger generations by, I think, 2048.
$124 trillion.
Wow. But if we narrow that view down just to the small business sector, which is really the engine of the American economy, we are still talking about a $10 trillion wave in business value expected to change hands over the next 2 decades.
Okay, $10 trillion just in small businesses. So let's unpack this. Our mission today is to dig into these numbers, figure out if Main Street is truly facing an extinction event, and what this massive, kind of confusing transition actually means for you listening out there, whether you're an average heir or maybe a potential new business owner. Let's start with section 1 then, the looming small business crisis. Why is this succession thing so much more acute for baby boomers than it was for the generations before them?
Well, it's basically a perfect storm of demographics and, frankly, changing culture. Every single day, 10,000 baby boomers reach retirement age.
Every day.
Every day. And over the next 2 decades, our sources indicate that 3 million small business owners over the age of 55 will be looking to exit. They built these businesses, and now they need a plan, to sell them or pass them on.
And that lack of a plan seems to be the critical, immediate crisis risk here, doesn't it?
Absolutely. That's the crux of it. Nearly half of these owners have no formal succession plan at all. None. They just sort of assume they'll figure it out when the time comes.
Which doesn't always work out.
Right. This inertia hits the market hard because even if they do manage to list their business for sale, meaning they commit to M&A, mergers, and acquisitions, the odds are actually stacked against them. Surveys show only 30% to 40% of small businesses listed are ever successfully sold.
Wait, only 30 to 40%?
Yeah. That means the odds of selling your life's work are worse than flipping a coin.
Wow. And here's where that societal shift you mentioned really kicks in, right? Unlike past generations where maybe the son or daughter inherited the hardware store or the accounting firm, the kids aren't stepping up.
Precisely. That traditional familial succession, it's really breaking down. Sources note that younger relatives often lack the interest or, well, one source controversially termed it the cultural work ethic, maybe, to manage these foundational businesses.
Different priorities.
Different priorities, different career paths. They're pursuing different, often more flexible careers. So that leaves third-party sales as the only viable option for millions of these owners.
Okay, so if there's potentially $10 trillion in value changing hands, why aren't the big institutional buyers like private equity, PE firms rushing in to scoop up all this inventory? It seems like a massive untapped opportunity on the surface.
Yeah, you'd think so, but this is where the business model just kind of breaks down for traditional large-scale finance. PE often struggles with small businesses mainly because of scale.
Scale, meaning the deals are too small.
Exactly. Diligence costs, all the legal and financial vetting required, are high, whether you're buying a $50 million business or a $500,000 one. It takes time and resources. But the resulting profit on those small deals is relatively low for a big fund.
Ah, okay. The return isn't worth the effort for them.
Pretty much. And crucially, PE firms typically operate on maybe a 5-year investment horizon. They want to buy, improve quickly, and sell. That short-term focus clashes, sometimes violently, with the long-term relationship-based growth that many successful community-embedded small businesses like your local manufacturers or service providers really require. It's an issue of strategy and, yeah, cost efficiency.
So the theory says we're facing this massive extinction event because of demographics. But if it's so critical, where's the flood? Section 2 challenges this whole tsunami metaphor. Some sources suggest it's more of a storm surge or even a slow trickle. If 10,000 boomers are hitting retirement daily, why hasn't the volume of deals just exploded?
That's the big disconnect, isn't it? The hype has been building for years, the tsunami's coming, yet the counter data is pretty stark. The number of sell-side M&A deals has actually dropped by about 15% each year since 2021.
Dropped, not surged.
Dropped. The wave is delayed. And if you look into why, you have to start with the deep human element.
Ah, right. For many boomers, that business isn't just an asset on a balance sheet. It's their entire identity.
Exactly. For them, selling is not just a financial transaction. It's an emotional reckoning. One source described the owner's attachment as maybe the single biggest factor causing them to just hang on, sometimes past the point of financial sense. They fear losing their status, their routine, their community connection.
It's everything they've known.
For decades, often. And this emotional inertia combines with that second major barrier we talked about, the lack of preparation. This just creates massive friction in the sales process.
Okay, so it creates deal friction and, I guess, deal failure, too.
Absolutely. We noted that, 67% of business owners with companies worth up to $50 million lack a formal exit plan, they haven't cleaned up their finances, they haven't formalized processes, maybe haven't identified clear growth levers for a new owner. They are basically unprepared sellers demanding top dollar for an unpolished product.
That doesn't sound like a recipe for a quick sale.
Not at all. And that lack of preparation contributes heavily to the 24% of attempted sales that eventually just fall through. Deals die because the foundation wasn't laid properly.
And maybe as a quick fix or just avoidance, they're simply postponing retirement, pushing it back.
Precisely. They are lengthening the transfer window significantly. The average retirement age for business owners has now shifted from the traditional 65 to about 71.
71, wow.
Yeah. So that turns what could have been a sudden tsunami into a slow, drawn-out wave, giving the market years, not months, to potentially absorb the supply.
Okay, now let's talk about the quality of that supply that is actually hitting the market. Are these the kinds of businesses that new entrepreneurs would actually, want to buy?
This is maybe the most important practical detail for potential buyers listening. A significant number of businesses that are available right now are, well, they're outdated, maybe barely profitable, and have little to no real enterprise value.
Like what kind of businesses?
Think small travel agencies operating entirely offline in today's world, or maybe single-location vacuum repair shops. Foundational, but maybe not high growth. Meanwhile, the truly high-quality businesses, what the sources call the cream of the crop, may be doing $2 million or $3 million in EBITDA.
EBITDA, so earnings before interest, taxes, depreciation, amortization, basically cash flow.
Right, the healthy ones. They're often quietly acquired almost immediately by PE firms that specialize in that size or by large industry roll-ups before they even hit the open market. So the average buyer scanning the listings is often left with, well, slim pickings.
And then you throw in the current financial environment on top of all that, which probably makes sellers even more cautious.
Absolutely. Current high interest rates make it expensive for buyers to get loans to finance acquisitions, which naturally depresses valuations. Sellers don't want to sell low.
Makes sense.
And sellers are playing a waiting game with tax policy. There's talk, potential changes, the potential for capital gains tax rates to nearly double from around 23.8% currently up to a possible 44.6% when you factor in federal and potential state taxes. I mean, imagine.
Almost half.
Yeah. Many owners are simply unwilling to sell their life's work only to hand over nearly half the profit to the government. So they wait. They wait for lower rates, maybe a more favorable tax climate.
Okay, so the SMB crisis seems real, but it's more of a slow burn driven by owner inertia, poor planning, maybe low-quality supply for the average buyer. Now let's zoom out again to that massive headline-grabbing number, the $124 trillion Great Wealth Transfer estimate. This sounds potentially life-changing for millennials and Gen Z.
It does. It sounds incredible. But we have to introduce some necessary context here, or as I sometimes like to call it, the myth-busting data. What's fascinating, and maybe sobering, is that the $124 trillion figure, massive as it is severely concentrated.
Concentrated how?
At the very top. In the U.S., 25% of all assets are held by just 1% of the population, and nearly 80% is held by the top 20%.
Okay, so 80% of the wealth is held by the top 20%. If they hold nearly everything, what does the reality of this transfer look like for the remaining 80% or even 90% of the population?
Well, frankly, it looks like disappointment. According to labor economists we looked at, after discounting the wealthiest 10% of Americans, the median inheritance for the remaining 90% is statistically close to zero.
Zero, like literally nothing.
For the median person in that bottom 90%, yes, essentially zero. For the vast majority of the population, this much hype transfer is, well, it's economically irrelevant.
Quite a contrast to the $124 trillion headline. This raises a crucial question then. If boomers as a generation were generally seen as affluent, they lived through decades of significant asset growth, why isn't more wealth trickling down to the middle class? Where did it go?
Debt and longevity. Those are the twin culprits, according to the data. Boomers are entering retirement with significantly more debt, particularly mortgages and home equity loans, than previous generations did.
Carrying debt later in life.
Much later. The data suggests their debt accumulation kind of outran their asset growth in many cases. And that debt, combined with soaring healthcare and especially long-term care costs, since people are now living well into their 90s much more commonly, that systematically consumes wealth before it can be transferred.
So a long retirement with high medical needs can just wipe out an estate.
It absolutely can. If your parents live, say, 25 years in retirement requiring escalating levels of medical or assisted living care, that inheritance often just vanishes paying those bills.
Which leads to a serious expectations gap, I imagine, for the younger generations. They might be looking at, say, rising house prices in their parents' neighborhood and assuming their parents are sitting on huge liquid nest eggs.
A huge gap, yeah, often fueled by those inflated asset prices on paper. One source said about 1/3 of millennials expect to receive an inheritance, yet only 22% of boomers actually expect to leave one.
That's a big mismatch.
It is. Millennials often overestimate the equity in their parents' homes because they see the high valuation, maybe on Zillow or something, but they fail to account for the underlying debt, the mortgage, the HELOC that boomers have carried well into their retirement years. And for a significant minority, the reality is actually the reverse. Adult children are giving money to their parents for support.
Okay, so we've established these two realities. The SMB crisis is a slow-motion problem of logistics and emotion, and the Great Wealth Transfer is largely an inheritance myth for about 90% of the population. But despite the fizzle, small businesses remain the lifeblood of the economy, right? They account for 40% of U.S. GDP. This inertia, this slow burn, it must create some kind of opportunity.
It absolutely does. A huge opportunity, actually, because the valuation gap is enormous. Since traditional private equity largely ignores these smaller businesses due to their size, these companies are often trading at multiples 2 to 3 times lower than larger companies in the same industries.
Lower prices because there are fewer buyers.
Fewer institutional buyers, exactly. This is the sweet spot for new entrepreneurs, for individual owner-operators.
So how do we solve that core structural problem we identified? Pairing experienced operators like, say, the auto shop manager with 15 years of experience, but maybe limited personal savings, with the necessary capital, because that seems to be where the real bottleneck is.
Right. And we are seeing a major shift towards specialized infrastructure and acquisition models designed specifically for this kind of forgotten middle market. The model of entrepreneurship through acquisition, or ETA, is booming. Yeah, entrepreneurship through acquisition. This is where an operator, maybe someone with industry experience, raises capital specifically to buy and then run a single existing business as the CEO. They're not starting from scratch. They're buying something established.
And crucially, the sources highlight that existing government tools, when they're applied to this specific problem, are actually incredibly effective at democratizing access to ownership.
They really are the backbone of this opportunity for many. SBA loans, Small Business Administration loans, offer favorable terms, often low down payments, specifically for these small business acquisitions.
But they work. People pay them back.
The model is proving exceptionally resilient. The average default rate for SBA business acquisition loans between, say, 2019 and 2024 was just 1.8%.
Wow, under 2% default rate. That's incredibly low.
It is. It's a powerful indication of the stability of these foundational service businesses that people are buying. They're not flashy startups. They're solid operations.
And beyond SBA, we're seeing new, maybe tech-first strategies trying to scale this model, right? Trying to allow institutional capital to finally manage these traditionally messy small transactions efficiently.
This is where we might break that barrier of high diligence costs we talked about earlier. The approach pioneered by folks like Dennis Avon focuses on a tech-first operation. They use AI, specialized software, to streamline the due diligence, the operations, the financing, making it actually profitable to manage multiple smaller acquisitions at scale.
So tech makes small deals viable for bigger money.
Potentially, yes. And critically, these newer models often use what they call an aligned partnership with a non-control structure. They don't swoop in, take over an asset strip like old school PE sometimes did. They aim to empower the local operators to become true independent owners, providing capital and support rather than just turning them into hired managers.
Okay, so this shifts the focus, doesn't it? From passively receiving wealth, which isn't happening for most, to actively creating wealth through ownership. Now, pivoting back quickly to wealth management. For those who do acquire wealth, or for that wealthy 10% inheriting, what do the younger generations, Gen X, Millennials, Gen Z, want from their financial advisors? Is it different?
Very different, according to the sources. They want a mentor and a collaborator, not just a spreadsheet jockey telling them to maintain a 60-40 portfolio.
The old 60% stocks, 40% bonds, standby?
Right. That model assumes low inflation, consistent growth cycles, a world that millennials and Gen Z simply haven't experienced in their adult lives. Their reality is volatility, uncertainty. They want guidance through that.
So the advisor's role is shifting from just asset allocation to something more like emotional and relational stewardship.
Precisely. Advisors need to initiate family meetings to discuss goals, values, the legacy, not just the money. They absolutely must recognize women as independent financial decision makers. Women control about 1/3 of assets now, and sources say they frequently switch advisors after losing a spouse if they don't feel heard.
Interesting, yeah.
It means addressing the complex emotional side of inheritance, having those difficult conversations, which traditional wealth managers often avoided. It's more holistic now.
Okay, so to wrap this deep dive up, we started by asking if the Silver Tsunami was a crisis or a myth. What's the final synthesis from the source material we looked at?
I think it's fair to say the crisis for small businesses is absolutely real, but it's playing out as a slow burn, not a sudden tidal wave. That's due to the friction created by owner inertia, that lack of planning, and maybe the uneven quality of the available supply.
Okay, so SMB crisis, real but slow, and the broader wealth transfer.
The broader great wealth transfer is massive in total dollars. Yes, that $124 trillion is real. But our sources definitively show it is highly, highly concentrated among the wealthiest 10%, maybe even the top 1%. For most people, it's not a factor.
So what does this all mean for the vast majority of you listening, that 90% of millennials and Gen Z perhaps wondering about their future?
Well, the clear implication from the sources is that the majority of the next generation will need to create their own wealth, not rely on inheritance. And given that increasing demand we see for mentorship and financial literacy, perhaps the ability to confidently acquire and operate a foundational business, even a stable, predictable, maybe boring one, like a local distribution firm or an accounting practice, becomes the new definition of achieving the American dream.
Interesting. So buying a business instead of waiting for an inheritance?
Exactly. The market seems primed to assist this shift from being a passive heir to becoming an active owner. And the real opportunity, the exciting story for the next decade, lies in filling that $10 trillion vacuum the baby boomers are slowly, inevitably leaving behind on Main Street. That gap, that's where the action's going to be.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.